Okay, so today we're going to unpack a really fascinating trade. One of those trades that gives you a rare peek into how the smart money really thinks. It's a great story, all about conviction, fear, and a huge bet on one of the most, well, kind of boring but stable businesses out there, self-storage.
And it all starts with this number right here, $28,350,000. In mid-February, one single institutional trader put a bet of that size on Public Storage. I mean, to put that in perspective, that's more than a private jet. All wagered on the idea that this one stock just won't go down much. It's an incredible amount of capital to put on the line for just one idea. And that, right there, is the big question we're going to tackle in this explainer. What did this trader see that maybe the rest of the market was missing? Why make such a high-conviction bet on a company that, let's be honest, most of us just kind of drive past on the highway without a second thought? So let's play detective for a minute. Let's break down the anatomy of the trade itself. We really need to understand the who, what, and when of this mysterious $28 million position. Okay, here are the raw details of the bet, and the structure. This is what's really fascinating. See, the trader didn't just go out and buy the stock. Nope, they used an option strategy called a short put. The simplest way to think about it is this. They got paid today for agreeing to buy the stock at a set price in the future. You can see they agreed to buy shares at $270, but only if the stock actually drops to that price. And look at that expiration date, March 2026. That's a serious long-term commitment. For taking on that obligation, they collected a cash payment right now, a premium, of $2.30 for every single share. So the key takeaway here is this. The trader is basically drawing a line in the sand. They're making a very powerful statement that they believe $270 is a fundamental floor for this company. They're so confident, in fact, that they're willing to buy millions of dollars worth of shares if it hits that price.
Now, to really appreciate the genius behind this, we need to decode what selling a put actually means, because this strategy is the entire foundation of their whole thesis. Okay, here's the simplest way to think about it. Selling a put is a lot like getting paid to set a buy order on a stock you already want to own. You collect cash right up front. If the stock stays above your price, $270 in this case, you just keep the cash. It's kind of like free money. The so-called risk is that you might be forced to buy the stock at the price you wanted anyway. And as we're about to see, that's a risk this trader was more than happy to take. And this brings us to maybe the most important number in this entire trade, the break-even price. Because the trader collected that $2.30 premium upfront, their actual cost, if they have to buy the shares, isn't $270, it's $267.70. They've essentially created their own personal discount on the purchase price. And this just brilliantly illustrates the mindset here. The trader isn't just hoping the stock stays up, they're signaling that they would be a very, very happy owner of Public Storage at an effective price of $267.70. It's a win-win in their eyes. Either they collect free income or they get to acquire a fantastic company at a great price. Okay, so the mechanics of the trade are definitely bullish. But that's only half the story, right? The other half is the company itself. What is it about Public Storage that justifies this level of confidence? I mean, why this company out of the thousands of companies that are out there? Why plant your flag on a self-storage REIT when there are so many other, flashier things happening in the market? Well, the answer lies in what investors call a moat. Public Storage is a financial fortress. As the industry leader, it's just a cash-generating machine. We're talking strong performance in key metrics like funds from operations, which is kind of like earnings for a real estate company. They have this incredibly robust cash generation and something called shadow growth from all the new properties they've bought, which is offsetting any slowdowns they might see elsewhere. This thing is built to last. And what's crucial is that they are not standing still. The company is in the middle of this brilliant strategy they call PS 4.0. They're using tech to automate rentals, to dynamically change prices. They're maintaining ridiculously high profit margins. We're talking mid-70s. And they're flexing their muscles, using their huge size to just gobble up smaller competitors. So this isn't some sleepy old landlord. This is a tech-enabled real estate giant in the making. So if the company is so strong and its strategy is so solid, where did this amazing trading opportunity even come from? Well, it came from a very powerful market emotion, good old-fashioned fear. So here's the paradox that created this whole situation. On one hand, the company just reported really strong results, right?
But on the other hand, management gave this very cautious, even negative guidance for the year ahead. They were signaling a challenging operating environment. And that cautious guidance, that created an opportunity. The source material puts it perfectly. This institutional player decided to sell the fear. They saw the market panicking about the future and decided that that panic was creating an opportunity to collect an inflated premium on these options.
And you can see the evidence of that fear right here. I mean, look at this wave of analyst downgrades in late January and early February. Wells Fargo, Bank of America, Wolf, Deutsche Bank, it was a whole chorus of caution. This is exactly what spikes uncertainty in the market, and it's what made the premium on those put options so unusually rich and ripe for the taking. This also explains why Public Storage was the perfect company for this. Unlike the huge binary risks you see in other sectors, like a massive railroad merger that could fail or a car company having to write off billions, the risks at Public Storage are manageable and predictable. It's a clean cash flow business, which is exactly what you want when you're making a bet of this size. So let's put all these pieces together. What's the final verdict? What makes this trade just a textbook example of sophisticated, institutional-level thinking? Well, first, just look at the math from an income perspective. That 230 premium might not sound like a lot, but if you could repeat a similar trade over a whole year, it would annualize to an incredible 8.18% return on the capital at risk. As you can see, that's nearly double the income you'd get just by buying the stock and collecting its dividend. It's a really powerful way to generate what they call synthetic income. And second, here's what's so brilliant. The worst-case scenario? It's still a great outcome. If the stock does fall and the shares get assigned, the trader ends up owning this blue-chip company at a price that gives them a 6.23% FFO yield. That's that key profitability metric we talked about. And historically, for a company this strong, that has been a fantastic long-term entry point. So you see, this wasn't just a simple bet. It was this beautiful, multi-dimensional thesis. It combined a clear valuation floor, a strong belief in the company's forward-looking strategy, a smart play against temporary market fear, and a deep, deep appreciation for the company's defensive business model.
And really, this is the bottom line. It all boils down to one powerful idea: a calculated bet that the market's short-term anxiety is totally overblown when you compare it to the company's durable, long-term fundamental strength.
Which leaves us with a final question, right? Is this trader a genius, seeing value where everyone else only saw fear? Is that $270 level a fortress, built on a mountain of cash flow? Or is it just a line in the sand, about to be washed away by a tide of bad news that the market actually saw coming? We've seen the logic, but only time is going to tell us who the winner is.